Hello dear students, myself CMA Padmaja Buzruk. I will discuss fundamentals of accounting. Please go to study note number 1 of group 1 paper 5. In this video, I will discuss objectives of accounting, accounting information and basic accounting terms. So first we'll start with objectives of accounting. The main objective of accounting is to provide financial information to the stakeholders. Stakeholders are users of accounting information like shareholders, money lenders, debtors, creditors, tax authorities, employees, etc. All these are various stakeholders who are interested in the financial information of organization. Their economic decisions are based on this financial information. And main objective of accounting is to provide financial information to the stakeholders. Now, how this financial information is provided? So, this financial information is provided through financial statements. Profit and loss account and balance sheet are two financial statements, and these financial statements are prepared on the basis of generally accepted accounting principles. And these statements are prepared using various accounting standards. So we have seen main objective. Now we'll see other objectives of accounting. To ascertain amount of profit or loss made by the business. That is, this profit or loss you will get by profit and loss account. Compare total income earned with total expenses incurred and you will get net profit or net loss. To know the financial position of the business. Financial position will be given by balance sheet, that is to assess what the business owns and what it owes to others. To provide a record for compliance with statute and laws applicable. So, next objective of accounting is to check whether required statutory books are maintained or not. Statutory books are the books which are required to be maintained compulsorily as per law. Whether profit and loss account and balance sheet is drawn as per relevant statute or not. That is nothing but provide record for compliance with statute and laws applicable. Next objective is to enable the readers to assess progress made by business over a period of time. Normally, last year's figures, previous figures, year's figures are also given in current financial statement, which helps the users of the accounting information to understand the progress made by the company. That is, whether the business is showing increasing trend or decreasing trend. To disclose information needed by different stakeholders. This has come under other objective, but we have seen this under main objective in the previous page. So whatever information these various stakeholders need, this information is disclosed by financial statements, profit and loss account and balance sheet. Disclose this information because economic decisions of stakeholders are based on financial statements. Now we'll see users of accounting information. Who uses accounting information? Accounting provides information to internal users and external users. Internal users are all the organizational participants at all levels of management, that is top level, middle level and lower level. So generally top level management require information for planning. Middle level management require information for controlling the operations. Now this information to internal users is provided in various forms of reports like cash budget, production report, idle time report, feedback report, whether to replace or retain any equipment, etc. etc. There are also external users, for example, banks and creditors. External users are basically interested in solvency and profitability of an enterprise. So it is very clear that internal users are users of accounting information from inside the organization, whereas external users are outsiders like banks and creditors. These external users, they do not have direct access to the records of an enterprise. So they have to rely on financial statements as a source of information. External users are interested in solvency and profitability of an enterprise. And these external users are also known as stakeholders. Now we'll see types of accounting information. Accounting information may be categorized in number of ways on the basis of purpose of accounting information, on the basis of measurement criteria, and so on. So accounting information is grouped, classified, categorized in various ways. Purpose will be different. So normally these accounting information are classified as first is information relating to financial transactions and events. So this accounting information relating to financial transactions and events is available from financial statements. Financial position, this is provided in balance sheet, that is assets and liabilities as well as capital, what the business owns and what it owes to others. Financial performance, this is provided in profit and loss account, which is also known as income statement, that is nothing but net profit or net loss. Cash flow, this is nothing but a statement prepared to show inflow of cash and outflow of cash and how the business arrived at closing cash balance from opening cash balance. So these three statements, balance sheet, profit and loss account and cash flow statement, gives accounting information relating to financial transactions and events. Second is accounting information relating to cost of a product, operation or function, that is cost of a product, cost of operation, cost of function. This accounting information is available from cost sheet. Cost accounting information is only for internal users. It is not revealed. It is not disclosed. Cost sheets are prepared product wise, operation wise, function wise, and this information is given to internal users. Third is accounting information relating to planning and controlling the activities of an enterprise for internal reporting. Accounting information relating to planning and controlling. So this is management accounting information for discharging various managerial functions like planning, organizing, coordinating, control, decision making. Managers need this information. This information again is classified as information relating to finance area. So this information is available to managers by cost accounting and financial accounting data. Like cost sheets and financial statement gives this information. Information relating to production area. So this information is about installed capacity, maximum capacity, actual production, idle capacity, etc. And production department provides this information. Next information is relating to marketing area. So this is nothing but information about ratio of sales to selling expenses to advertisement. What is the total expenditure on advertisement? Is there any new market? What is the selling cost, etc. Information relating to personnel area. So here information about labor turnover, efficiency of labor, idle time, etc. This information is relating to personnel area. Information relating to other areas like research and development. That is, what is the total amount incurred on research and development activity, whether this activity got success, whether the research is successful or not. This information is given. Next information is accounting information relating to social effect of business decisions. There are certain business decisions like setting up of unit in backward area, local purchase of raw material, employment of local workers. What are their effects? That is accounting information relating to social effect of business decisions. Accounting information relating to environment and ecology, waste management, pollution control, CSR activities. All this needs expenditure. All this involves expenditure incurrence, and information about this is provided to the management. This is again internal information for internal users. Accounting information relating to human resources. Human resources are employees of the organization. So accounting information is nothing but what is the cost of recruitment, training, bonus paid to various workers, etc. So these are various types of accounting information. Now we'll go to next important part, basic accounting terms. Common expressions used in business accounting are, what are the various basic accounting terms that we'll see one by one? First is transaction. It means an event or a business activity which involves exchange of money or money's worth between parties. Transaction could be cash transaction or credit transaction. Only monetary transactions are recorded in the books of accounts. So when parties settle the transaction immediately by paying cash or by check, it is known as cash transaction. In credit transaction, the payment is settled at future date as per agreement entered into between the parties. So transaction is any business activity which involves exchange or of money or money's worth between the parties. Only monetary transactions are to be recorded in the books of accounts, and transactions can be cash or credit transactions. Next is goods or services. Goods are tangible article or commodity in which a business deals. Tangible is which you can see, which you can touch, which you can feel. These tangible articles, things, commodities in which the business deals is goods. These articles and commodities, either it can be bought and sold, or businessman can produce it and he can sell this. But this goods term from one particular business point of view can be asset from some other business point of view like machinery. Whereas services are intangible in nature. These services are rendered with the object of earning profit. Sometimes services are rendered without object of earning profit. So goods are tangible in nature, services are intangible in nature. Services are rendered, and for that fees are charged. Objective is to earn profit. Sometimes services are rendered voluntarily where there is no object of earning profit. What is profit? Excess of revenue income over revenue expenses is called profit. If your total income is more than total expenditure, it is profit. And if it is exactly opposite, if your total expenditure is more than total income, then it is called loss. Next is asset. Asset is a resource owned by business with the purpose of using it for generating future profit. So assets are resources owned by business. And there is a purpose why these resources are owned, for making future profit. Assets can be tangible and intangible assets. An asset can also be classified as current assets and non-current assets. Tangible assets are capital assets which have physical existence. So you can touch, feel these tangible assets like plant machinery, furniture, land and building, books, computers, vehicles. But the assets which do not have physical existence, which you cannot see, which you cannot touch, feel, they are known as intangible assets, but they help to generate revenue in future. Examples are goodwill, patents, trademarks, copyright, franchises, etc. Assets are again classified as current and non-current assets. Current assets are those assets which get turned into cash within one accounting period. Supposing if the asset is hold for more than one accounting period, more than one company's one operating cycle, then it is non-current asset. So, example of current assets are cash and bank balance, sundry debtors, bills receivable, prepaid expenses. All these are examples of current assets. So assets which get converted into cash within one accounting period are known as current assets. Next is liability. It is an obligation of financial nature to be settled at future date. So liability is obligation which is to be settled in future. It represents amount of money that the business owes to other parties. Again, liabilities are classified as long term, which is also known as non-current liabilities, or short term or current liabilities. When goods are purchased on credit, the firm will create an obligation to pay to the supplier, that is, from whom the goods are purchased, the price of goods on agreed future date. Supposing a loan is taken from bank, it is necessary for the businessman to pay interest and principal amount as per agreement. It is an obligation to pay this. And depending upon the period of holding, this obligation could be classified into long term or non-current liabilities and short-term or current liabilities. Current liabilities are those liabilities which are expected to be settled within a period of one accounting year, that is within a period of 12 months. And liabilities which are supposed to be settled beyond 1 year are classified as non-current liabilities. If loan is taken for a period of 5 years, you can call it as non-current liabilities. Sundry creditors, bills payable, bank overdraft, outstanding expenses, all these are examples of current liabilities. Now, internal liability is also important. Internal liability is nothing but proprietor's equity. So, which is the amount which the proprietor is entitled to get which is proprietor's capital, reserves and surplus, undistributed profit. The proprietor is entitled to get from business the capital which he has contributed plus undistributed profits. Together, it is termed as internal liability. Contingent liability. It represents a potential obligation that could be created depending on outcome of an event. Contingent liability is not recorded in the books of account but disclosed by way of note to the financial statements. So in short, contingent liability is a liability which may arise or may not arise and which depends upon outcome of future event. For example, if supplier of business files a legal suit, it will not be treated as liability because no obligation is created immediately unless and until the judge gives his results judgment regarding this suit legal case. Till that you cannot consider it as actual liability. It is not to be accounted for in books, but it is to be shown disclosed by way of note to the balance sheet. Next important term is working capital. In order to maintain flow of revenue from operation, every firm needs certain amount of current assets. We have discussed what are current assets. Total of current assets is known as gross working capital, and current assets minus current liabilities is known as net working capital. So gross working capital, either you take total of current assets or you can use this another formula for getting gross working capital, that is long term internal liabilities plus long term debt plus current liabilities minus fixed assets. So from the liabilities side, if you deduct fixed assets, you will get total current assets, which is known as gross working capital. Net working capital is current assets minus current liabilities. We have seen examples of current assets and current liabilities. I have already told about this. Next is capital. It is amount invested in the business by owner. It may be in the form of cash, goods, or any other asset which the proprietor or partner of business invest in the business activity. For corporate entities, corporate bodies, capital is normally represented as share capital. So capital is whatever owner has contributed to start the business. From business point of view, capital is liability towards owners, which the business will settle only in the event of closure of the business. And that is the reason why capital is shown on the liabilities side of the balance sheet. Next is drawings. It represents an amount of cash, goods, or any other asset which the owner withdraw from business for his or her personal use. For example, if life insurance premium of proprietor or partner of business is paid from business cash, it is called drawings. So this is nothing but cash withdrawn or goods withdrawn by owner of the business for his personal use, which is known as drawings, and drawing is to be deducted from capital. Next is net worth. Net worth represents excess of total assets over total liabilities. It is also termed as owner's equity. So this is nothing but amount contributed by owner in the form of capital plus undistributed profits is known as owner's equity. Non-current investments. Investments are of two types, current investments and non-current investments. Non-current investments are investments which are held beyond current period as to sale or disposal. For example, fixed deposit for 5 years. Current investments are investments that are readily realizable and are intended to be held for not more than 1 year from the date on which investment is made. So, if investment is held for a period of 1 year or shorter than that, then it is current investment. If it is beyond 1 year, then it is known as non current investment. Next important term is debtor. Normally, businessman sells goods on credit. When goods are sold on credit, sales account is credited and customers account is debited, and all these credit customers together collectively they are known as debtors. The sum total or aggregate of the amount which the customer owe to business for purchasing goods on credit or services rendered or in respect of other contractual obligation is known as sundry debtors or trade debtors or trade receivable or book dates or debtors. So debtors are those persons from whom a business has to recover money on account of goods sold or services rendered on credit. Again, debtors are classified as good debts. That is, if the business is 100% sure of realizing the amount, it is good debts. If there is some doubt about realization from debtors, then you can classify it as doubtful debts. If the businessman is sure that 100% he is not going to recover money from debtors because the debtor has become insolvent, bankrupt, you can classify it as bad debts. So, while ascertaining debtors balance at the end of the period, you need to do various adjustments like bad debts, return involved, discount allowed, etc. Businessman purchases goods on credit. When he purchases goods on credit, he is supposed to pass journal entry, purchases account debit to supplier. All these credit suppliers of goods together collectively they are known as creditors. A creditor is a person to whom the business owes money or money is worth. For example, money payable to supplier of goods or provider of service. Creditors are generally classified as current liabilities. Debtors are current assets and creditors are current liabilities. Next is capital expenditure. This represents expenditure incurred for the purpose of acquiring fixed asset which is intended to be used over long term for earning profit. Capital expenditure forms part of balance sheet. Capital expenditure is non-recurring in nature. So every month, every year, every now and then you won't incur capital expenditure. So that is non-recurring in nature. It is not repetitive in nature. You will get benefited from capital expenditure in future and it forms part of balance sheet. Revenue expenditure. This represents expenditure incurred to earn revenue of current period. The benefit of revenue expenses get exhausted in the year of incurrence. For example, repairs, insurance, salary and wages to employees, travel, etc. Revenue expenditure result in reduction in profit or surplus. It forms part of income statement. Income statement is profit and loss account. So revenue expenditure is recurring in nature. It is repetitive in nature. The businessman incurs spend on account of these expenditure every month, every year, repetitively. Benefit of this revenue expenditure gets exhausted in that year itself. It is not available in future and which is shown in profit and loss account. Next is balance sheet. Balance sheet is a statement which gives financial position of business as on a particular date. That is the reason why heading of balance sheet is always as on or as at a particular date. So this balance sheet gives list of assets, liabilities as well as capital. It is prepared after incorporating resulting profit and loss of income statement. So in short, it is nothing but net profit or net loss from profit and loss account gets transferred to balance sheet, that is in capital. Next is profit and loss account, which is also known as income statement. This account shows revenue earned by business and expenses incurred by business to earn that revenue. This is prepared usually for a particular accounting period, which could be month, quarter, half year or a year. Normally, profit and loss account is prepared for period of 12 months, that is 1 year, and that is the reason why heading of profit and loss account is always for the year ended. This profit and loss account will give you net profit or net loss, which gets transferred to balance sheet. Next is trade discount. Trade discount is discount usually allowed by wholesaler to retailer, which is computed on list price or invoice price. One example is given. List price of TV is 15,000. Wholesaler may allow 20% discount to retailer. That means the retailer will get it for 12,000 and is expected to sell it to final customer at the list price. Trade discount is not recorded in the books of accounts. So discount given by wholesaler to retailer is known as trade discount. It is not to be recorded in the books of accounts, but amount recorded to be recorded is after deducting trade discount. Next is cash discount. Cash discount is allowed to encourage prompt payment by debtor. This is to be recorded in the books of accounts and this is to be calculated after deducting trade discount. If list price is 15,000 on which trade discount of 20% and cash discount of 2% apply, then पहले आपको क्या करना पड़ेगा? Find out trade discount which is 3,000, 20% of 15,000. It will be deducted. So 15,000 minus 3,000 will be 12,000 and cash discount 2% will be calculated on 12,000. Hence, cash discount will be 242% of 12,000 and net amount payable will be 12,000 minus 240, 11,760. So, in short, cash discount is given to encourage debtors to make prompt payment. It is a loss of business and it is debited to profit and loss account. In this particular video, I have discussed about objectives of accounting, users of accounting information, types of accounting information, and various basic accounting terms. Thank you.